next video of our cash flow statement. First class we have done that what is cash flow, why we do cash flow, and what are the necessity of cash flow statement. I just revise or recap once. So cash flow statement means cash, I told you, cash and cash equivalent. Cash and cash equivalent means three things. One is cash, most liquid one, then your bank balance and marketable securities. These three is called cash and cash equivalent. Flow means change of inflow and outflow of cash of balance sheet items. And statement means we prepare documents. So generally we are preparing our documents or statement where we analyze our cash and cash equivalent through our balance sheets, and we're using the three activities. It is divided in operating activities, investing activities and financing activities. In short, financing activities means fund from where a company raised the fund. For example, what are the main sources of fund? Equity share capital is one of the source of capital. Then preference share of capital. Then your debenture loan. So when company issue equity shares, issue preference shares, or issue the debenture or raise loan from any financial institutions, so it means company fund increases. Company, when fund increases, it means a company's cash inflow. When they issue shares or issue debentures, this cash inflow. Similarly, the equity shareholder, preference shareholders, debenture holder and bank, what they expect from your company? They expect from your company, equity shareholder, they expect dividend, good return from your company. Preference shareholder also expect dividend from your company. Debenture holder, they expect interest from you. And loan provider, that is the financial institution, banks, they also want interest from you. So when you pay dividend, when you pay interest, it means your cash outflow from your business. So this one comes under financing activities. Whenever your equity shares, preference shares, debenture, loans, these are related to our financing activities, we will record here. Financing activities. It means what is the change? Inflow, when you issue it, it is inflow. When you pay the dividend, pay the interest, it is called outflow. So net change we will write in this activities. Now what is investing activities? Investing activities basically deals with the fixed assets. Fixed assets of our company. Now what is fixed assets? Fixed assets means those assets which a company use more than a year and getting the economic benefit from that assets. Fixed asset is two types. One is tangible, means you can touch, there is a physical existence, you can see the assets. For example, land and building, plant and machinery, furniture. These are the fixed asset, fixed tangible asset. Similarly, there is an intangible asset. Intangible asset like your goodwill, patent, copyright, trademark. There is no physical existence. You cannot touch, you cannot see. But this asset creates value for the company. So whenever there is a assets related to assets, it is come under the investment activities. So cash flow means change. So whenever you purchase assets, it means your cash outflow. Whenever you sold the assets, it means cash inflow. So we will write the change, the inflow. Remember one thing. For example, there is a 2-year, say machinery. Machinery is our fixed assets. So fixed asset, tangible fixed assets. We have 2 years, 24, 25. There is a two value given, 210, 280. Current year is 25, previous year is 24. But remember one thing, in our cash flow statement, we will not record 210,000, we will not record 280,000. Then what we record? Flow. Flow means change. What is the change between these two? Current year 280, previous year 210. So 70,000 is the change. So your assets increases. Your asset increases from 210 to 280. Your assets increases. So there is a principle in cash flow statement. What is the principle? To complete this statement, you need to remember the principle. So whenever asset increases, it's mean cash outflow. Your purchase, your machinery increases from 2,10,000 to 2,80,000. So 70,000 is a change. It means you maybe purchase the assets. That's why your asset increases, cash outflow. So whenever you purchase asset, cash goes out from your business. Similarly, if your assets value decreases, it means what? Your asset value decreases means you maybe sold the assets. So if you sell the assets, it means cash comes into your business if you sell your asset. So you receive the cash. So whenever you receive the cash, it means cash inflow. So remember, we will not write or record 2,10,000. We will not record 2,80,000. What we record? The change. What is the change? 70,000 is the change. So we record the 70,000, that change. So 70,000 increases, it means it is outflow. Why this outflow? Because we purchase the assets. That's why cash outflow from your business. So this one investing activity. So remember, financing means fund. You raise the fund because without fund, without finance, you cannot purchase assets. And without assets, you cannot operate your business. So to operate your business, operate means production, purchase, sales, pay the salary, pay wages, all these things is included in operation part. So to operate the business, you also need assets. To operate the business, you also need the finance. So in our operating activities, which is a core part of any business operating activities, there is two methods to complete it. One is direct methods, another one is the indirect methods. Today I am following the indirect methods. What is indirect method? Indirect method of operating activities which start from net profit. Net profit before tax and extraordinary items. So we start from the net profit. It is indirect methods, not direct methods. Direct method is different. We will discuss later. So indirect method, we start from net profit. Now what is net profit? Which net profit? It is back calculations. So whenever it is a net profit, it means profit and loss statement. So in our profit and loss statement, if I say there is a cost of goods sold and there is a sales closing stock, we will get the gross profit. This gross profit transferred to profit and loss account. Gross profit. So this gross profit. So gross profit, and then we get the indirect expenses. All you know that. Then we get the net profit. So we are starting from this part. This is for indirect method. If it is direct method, we directly record sales, cost of goods sold, and other indirect expenses. It is for direct. But indirect means we start from at the end, means net profit, and the back calculation. It means add back. It is called indirect method. Why I choose indirect method? Because worldwide indirect method is a favorable one, is a preference one. So that's why any of our question, our syllabus is based on that. So that's why indirect method, we start from this part, net profit, and from this net profit we adjust, we add the adjustment. Adjustment of what? Non-cash item. So we adjust the non-cash item. So what are the non-cash items? Non-cash item means depreciation, preliminary expenses, goodwill written off, preliminary expenses written off, any kind of loss. These are called our non-cash item. So we adjust our non-cash item with our net profit. Okay, clear? So today, on the basis of this concept, so basically we divide it in three parts: operating, investing, and financing. We are taking a problem. See, this is our problem. So this one is our question paper. This is one of the balance sheet. From this balance sheet, we analyze the cash flow statement of a company. So in our balance sheets, there is a liability side, 2 years given. We compare the 2 years. 25 is our current year 24 is our previous year. Okay, similarly assets. Assets also 2 years, 24 and 25, current year and previous year. So basically we look for the change. So let's start. Always remember in cash flow statement, we start from the end. What the end? What is the closing balance of cash and cash equivalent? What is the opening balance of cash and cash equivalent? And the net increase in cash and cash equivalent. See, closing balance of cash and cash equivalent. I told you, it means cash, bank balance and marketable securities. So here, cash is not directly given, but cash equivalent given. What? This one, bank balance. See, bank balance is a cash and cash equivalent. So what is my opening balance? Previous year, 24 is my opening balance. What is my closing balance? 25 balance is my closing balance. So we start from closing. See, so closing balance of cash and cash equivalent. So in my final amount column, 15,000, it is my closing cash balance. Okay. Now what is the opening cash and cash equivalent? See, that are 11,000. 11,000 is my opening. So write 11,000. 11,000 my opening balance. So now you tell me, so this is 11,000, 11,000 opening. So what is the net change? 15,000, 11,000. So what amount I need to add to get the 15,000? 4,000. If I add the 4,000, then we get the 15,000. So 4,000 is called the net increase in cash and cash equivalent. It's simple. Closing balance of cash equivalent given in your question paper 15,000. Opening balance also given in your question paper, it is 11,000. So what is the net change? 4,000. So 4 plus 11, 15,000. Now what is the beauty of account? We will prove that 4,000 change of cash and cash equivalent may be happen due to operating activities, due to investing activities, due to financing activities. But what cause and effect behind it, we will prove through the balance sheets. We will analyze every items of assets and liabilities of balance sheets and prove we segregate of assets and liabilities in these three activities, and we will prove that which activity involved for this change of 4,000. Which activities involved for the change of 4,000. So you analyze, start from the asset side. Come here, start from asset side, machinery. 2,10,000, 2,80,000. So what is the change? First you tell me, machinery comes in which activity? Operating, investing or financing? Machinery is the asset. I told you asset in which activity? Yes, investing activity. So come to your investment activities, because fixed assets is related to our investment activity. So simply machinery 2,10,000 to 2,80,000, 70,000 increases. And what is the rules? If your assets increases, it is cash outflow. It means you purchase. So right here, purchase of machinery. Purchase of machinery. So we write the change. So it is in outflow. Outflow we will write within the bracket. It means minus 70,000. Minus 70,000 it means your cash outflow. Achha, machinery done. Come to our debtors side. Debtors is 9683. 9683. So debtors is current assets. Debtors are our current assets. Machinery, land and building, plant and machinery, fixed asset. Now what is current asset? Current assets are those assets